Hello, this is Tim Congdon, Chairman of the Institute of International Monetary Research at the University of Buckingham. This is the monthly presentation on global monetary trends and the background to them. It's been given at the end of September 2020. The big topic of conversation in this part of public policy in the last few months has been the very large budget deficits governments have incurred because of the COVID-19 pandemic, and then the related extremely rapid growth of the quantity of money, particularly in the United States, that I've been highlighting in the last few presentations of this sort. I think what I'll do today is just recap very quickly on those money trends. And then I'm going to express some concern about the intellectual context of economic policy making today. And I'm going to be criticizing new Keynesianism, which I'll explain what that's all about as we go along. I'm going to start off with Eurozone money growth. The highest rate of growth of money in the Eurozone, as elsewhere, was in the spring, April, May, and it's fallen back a little bit, but it's still, in the last 2 or 3 months, higher than it was a year ago. So the annual rate of increase has moved up to double digits. In the year to July, the increase in M3 was 10.2%, and that is the highest figure since about 15 years ago. In Japan, the rate of money growth again has picked up, and although these numbers are moderate by the standards of other countries, the annual rate of increase is just over 7%, and that is the highest figure for 30 years. In the UK, again, we've come off the peak rates of growth, but they remain higher than a year ago, so the annual rate is up to over 12%. The exception, in one sense, at any rate, is the United States. Here we had money growth in the year to June of over 26%. But in the last 2 months, July and August, there's been no growth, more or less, of the quantity of money. So the annual rate of growth is slipping back a bit, back towards 24, maybe lower, 24% or lower. But that figure is still the highest since the Second World War, highest since 1943. And it's really on the United States that I want to concentrate today. The Federal Reserve is nowadays very much dominated by a school of thought called New Keynesianism, and in my view that sets up a number of issues and problems for the future. Notice an exchange a few days ago at a press conference given by Jay Powell, the Fed chairman. Excuse me, I'm going to read this out. There was a journalist who asked, do you really think that you've had the Fed's announced a new policy regime for monetary policy making? It's going to be aiming at have 2% as the average rate, will be relatively easygoing if the inflation rate's above 2%. The question from the journalist was, can you get inflation up to 2%? Doubts about that, apparently. So Mr. Powell said, the moment the economy is recovering quickly, but that pace will slow as people get back to work, and we'll still have an area of the economy, a big area of the economy that struggles. There'll be slack in the economy. The economy will be below maximum employment, below top demand, and that will tend to put downward pressure on inflation. So it's going to keep inflation down some years in the future, despite that 26% money growth we had in the year to June. Now, evidently, there are many people in the United States in influential positions in the economic world and finance, who really do believe that the United States cannot get inflation above 2%. That's even though in the year to July, inflation in Venezuela was 2,358.5%, and in Argentina it was 39.2%. One wonders what it is that's so magical about these places, I can put it that way, that they can have inflation at those sort of rates. But in America, apparently they can't get it above 2%. They can't go from 1.2 or 1.3% to 2%. And I want now to try and understand what's going on here. Of course, to me, it's extremely simple to raise inflation from 1% to 2%. You should simply raise the rate of money supply growth from 2 or 3%, maybe 3 or 4%, to 7 or 8%. Keep on doing that, inflation will take off all right. In macroeconomics, there's a constant flow of new ideas and almost a rotation of ideas as the decades go by. In the early post-war decades, there was what was called the Keynesian revolution. I won't talk about that very much now, but the guts of it was that the government might spend more to boost spending and achieve full employment. That then led to a lot of inflation in the 1970s. There's a lot more to say, I'm just moving very quickly. There was then the monetarist counter-revolution, which in a sense began, I suppose, with Friedman's 1967 presidential address to the American Economic Association and rolled on for about 20 years at some point in the mid-1980s. This monetarist counter-revolution was really a kind of reiteration of the quantity theory of money, which went back decades and indeed centuries. But then since the late 80s, early 90s, we've had a reappraisal both in the academic world and in policy-making world of central banks and finance ministries. We've had a reappraisal, and what we have what I call the new Keynesian counter-revolution. And I suppose the leading texts here, the leading sort of focus of discussion are a 1999 paper in the Journal of Economic Literature by Richard Clarida, Gali, and Gertler, and then Michael Woodford's 2003 book, Interest and Prices. Origins go back further than that, but okay. Now, in order to understand what was motivating New Keynesianism, we need just to think for a little bit about the monetarist counter-revolution, which undoubtedly was very much associated with Milton Friedman. Now, Friedman insisted, first of all, that inflation is always and everywhere a monetary phenomenon. It arises because the quantity of money is rising faster than the quantity of goods and services. He said that there is no long-run trade-off between unemployment and inflation, which destroys the intellectual basis for chasing a full employment target. Just policymakers should concentrate on price stability, low inflation, let the labour market sort itself out, and eventually the price stability will help the labour market to work efficiently, and leave it at that. And finally, he rejected this whole idea of using fiscal policy to manage the economy, and he advocated stable growth of the quantity of money. Now, I'm very much in that school of thought. I don't think the arguments have been refuted at all. And in my July presentation, I contrasted the rates of growth of money and nominal GDP in the USA until the mid-50s with the subsequent behavior of those numbers of money, nominal GDP. You can see how much more stable things have been since the late 1950s, partly because of Friedman influence, and the economy has been more stable as well. First half of the 20th century was full of wars and depressions and booms and busts, less so the second half. And the evidence behind monetarism, behind the quantity theory, is pretty clear-cut. There is a relationship between the rate of growth of money and nominal GDP, and between real money and real GDP. And, you know, there's an awful lot to say here. I've just summarized some of this information in this table. The ideas are controversial, but please, they're not silly. That's what in my view, that was the background to the defeat of inflation in the 1980s and the 1990s, and also to the period of very good macroeconomic outcomes, stable growth with low inflation, called the Great Moderation, from the early 80s to 2007, 2008. Now, already towards the end of that period, in the late 1990s and the early years of the 21st century, there was a reaction against monetarism in academic circles. And so we had, as I say, what I'm calling the new Keynesian counter revolution. And unlike Milton Friedman, economists of this school of thought believed that the market economy suffered from failures. Parts of it didn't work very well. Labour market was subject to rigidities and delays and bargaining and all sorts of trouble. The idea of money targets was discredited. So monetary policy came to be seen as purely the setting of the short-term interest rate, which became the factotum of monetary policy in this school of thought. And although views differed about fiscal policy among different new Keynesian economists, there was more time for fiscal policy, greater respect for taking action to change government spending and taxes to influence the economy. The culmination of these developments was a paper in 1999, I just referred to it, by Clarida, Gali and Gertler on the science of monetary policy in a new Keynesian perspective. This article just got rid of money altogether, basically, in monetary policy making. And it said that we can think about the economy in terms of just three equations. One of them is an equation, excuse the technicalities, but it's called the IS function, the IS curve, the IS equation, in which aggregate demand depends on the central bank interest rate. There's then a Taylor rule, after John Taylor, who worked at the US Treasury for a time. And this shows how the Federal Reserve, other central banks, change interest rates in response to numbers on inflation and something called the output gap. The output gap picking up the difference between actual output and trend output. And then the third equation, which went actually back to Friedman's work, was something called the expectations augmented Phillips curve, although it again was in terms of the output gap, not just the labour market. And the essence of this was that there is no long-run trade-off between unemployment and inflation, but there may be some short-run trade-offs. One of the consequences of that was to make inflation expectations very important in the setting of inflation. What did these ideas then mean for policy making? Well, Friedman's work said central banks should be looking at money growth, the behavior of money relative to some desired figure all the time. The new Keynesians said, don't look at money at all. I've noticed that the new Keynesians do have a lot of analysis of the labour market. They do pay attention to the link between unemployment and inflation. But recent experience suggests to them that there is no such relationship. And there has indeed been talk by Richard Clarida, now chairman of the Federal Reserve, one of the authors of that 1999 article, now vice chairman of the Federal Reserve, about a flat Phillips curve, complete antithesis of Friedman's idea of a vertical Phillips curve. And then there are some new Keynesian economists who believe that when central bank interest rate has dropped to zero, monetary policy can do nothing further, because to their monetary policy it's about only the central bank interest rate. And so they favour the use of fiscal policy to influence demand, again completely reversing the position that Friedman had at the peak of his career. So this is a counter revolution to the monetarist revolution. And I think it's very important for you to realize that these people are now very influential in setting American monetary policy. This idea of this flat Phillips curve, well, this is what Jay Powell Jay Powell is not himself an economist, but he's picked up quite a lot of the material from his colleagues, I suppose, at the Fed. This is talking before Congress in July last year. He said that the connection between economic slack and inflation was strong 50 years ago. And he said that it's become weaker and weaker and weaker to the point where it's a faint heartbeat you can hardly hear now. In discussing why this weakening had occurred, he said, one reason is just that inflation expectations are so settled. And that's what we think drives inflation. If that were really true, if inflation expectations were to drive inflation, then I put it to you, why can't Venezuela get its inflation rate down from almost 2,500% to 2%, quite painlessly just by announcing that that should be the expected inflation rate? Or why can't Argentina get it down from the more modest figure of almost 40%? In my view, this is nonsense. Inflation continues to reflect the rate of growth, the quantity of money, relative to the rate of growth of goods and services. And let's just think about the United States in the last decade. The chart of the growth of broad money is a straight line until 2020 is a straight line at about 4%. That's what explains low US inflation, not this stuff about inflation expectations in the labour market. And I suspect in the next year or two we're going to see just how important that money growth acceleration really is. I'm not expecting America to get to the kind of depths or heights, if you want to put it that way, of these Latin American countries. But the notion that there's a flat Phillips curve and that it doesn't matter to inflation what happened to demand and money growth, in my view, is balmy. There's an awful lot to say. I'm just going to focus in the final few minutes on just one of these relationships, those three equations in the 1999 article on the science of monetary policy. There's supposed to be this idea that if the central bank raises interest rates, that reduces the growth of demand. If it reduces them, that boosts the growth of demand. And this is supposed to be a very reliable relationship, far better than anything in monetary in monetary economics using the quantity of money as such. Here is the relationship between the real Fed funds rate going back to 1954 and the growth of US output. Look at it. There isn't one. Look at the numbers decade by decade, as I did with money numbers, money growth as opposed to growth of nominal GDP. You see, look at this. You've got, in the 1980s, you've got relatively strong growth of real output and very high real interest rates of 5%, nominal rates of 10%. And then in more recent, the last 20 years, the 21st century, you've had practically zero Fed funds rate, real terms, and you've had very low growth of demand and output. If you take an equation of this is very primitive stuff, but I'm going to introduce something more. It's all wrong. The coefficient on the output term is positive. It should be the case when interest rates go up that output growth goes down. That's not what the figures say applies in the American economy over these decades. And when you compare that, it's rubbish, with monetary data, the money comes out much better. Of course, there are many academic papers on this subject. There's one here that by a chap called Livio Straka, who is an economist at the European Central Bank, and that you can read that and you can see that he's very critical of it. And there's also an article done about 15 years ago by Charles Goodhart and Boris Hoffman, an economist at the Bank for International Settlements at that time, where they too had trouble finding this IS curve. The real interest rate does not have a significantly negative effect on the output gap. get everything to work properly, they needed to include asset prices and monetary aggregates, the quantity of money. There's an awful lot more to say about New Keynesianism. All I want to get over to you is that at the moment, at the top of US macroeconomic policy making in the Federal Reserve and the US Treasury, there is no interest in the explosion of money growth that has occurred in recent months. There are even people who think that the United States cannot get inflation above 2%, a bit like Japan. There is no interest in the behavior of the quantity of money, and the reliance is on a set of ideas which, in my opinion, has been very much overblown and isn't securely based in fact. Thank you.